Welcome back to Primary Source China Investment. Peng.guo and I are here with Show R. And this week we want to talk about two items. The first is real estate. A lot of news came out recently about the real estate sector, and we're going to get into that. And the second, if you hold on, is going to be what's in this ETF anyway, where we break down a large emerging market ETF. So first up, we've talked about real estate in the past, and rightly so, since it's a huge driver of economic activity on the mainland. And it's also the single largest asset class, something we talked about in the past. So for perspective, housing value is 8 times the stock market. In the US, housing is only about 2/3 of the stock market. And this week there was news that China lowered the loan prime rate 10 basis points from 380 to 370. And there's no exact science here, but a 10 basis point move sounds small, but it does have huge knock-on effects because real estate, property, and related industries are up to 30% of GDP in China. So what do you think this small move in this loan prime rate, Peng.guo, what do you think is going to be the effect of this change?
I think generally the central bank, they always have some, they call the accurate adjustment. So they try to lower the interest rate or adjust the rate or deposit to certain area. So I believe this is probably like the signal they want to increase the supply as well as reduce the market pressure in the real estate area. So as we know, the Evergrande, they have the pretty much bankrupt, and a lot of the real estate projects that get affected. So that's really affect a lot of the people as well as the bank.
Yeah, some of the numbers that came out this week, Evergrande we know has 300 billion in liabilities. Not quite sure where that's going to come from. Kaisa already went bankrupt, and Fantasia went bankrupt. The other thing that came out was sort of growth numbers related to the real estate sector, and the overall real estate sector grew 4.4% in 2021, but December had a 13.2% decrease in investment, according to JP Morgan. And then another indicator was total floor area for new residential construction. Construction actually contracted 11%, and new home sales in the 50 major cities dropped 26.8% year on year. So you have a lack of demand, and then you have a decrease in supply, perhaps because of the lanwei, the buildings that didn't get finished from a lot of these large developers.
That's exactly right. I think the real estate right now is pretty in harder situations. So initially, from history, China really, the population get increase and the economy get soared. That's a real estate business get increased in the past 30 years. So everybody get a good experience and rely on this single sectors. Pretty much many local government, they heavily rely on the real estate to get the revenue. Another big change is the China population. So as we know, in the 2021, the totally new persons, I think is around 300,000. Compared with 1.4 billion country. That's the lowest number. Yeah, obviously the huge pressures right now.
You brought up a good point earlier. You said real estate's really been a one-way trade for a long time. So what people may not realize is private real estate ownership is a relatively new phenomenon in China, only since 1998. And since then it's really created a ton of wealth for individuals, and it's been a huge driver of growth. And it seems that Beijing wants to simultaneously rein in the real estate sector and then continue to lean on it for growth. It is a delicate balancing act. I'm not sure they're going to be able to stick the landing on that. So what might happen? Well, state intervention becomes more heavy-handed, rewarding these state-owned large-scale developers so that others don't go bankrupt, and then also controlling their profitability, setting prices to curb downstream speculation. And there's also the specter of real estate taxes that are on the horizon. This is something that's sort of been implemented in some larger cities. So those kind of things are big headwinds. And the government definitely seems like they're going to be heavy-handed with respect to the entire sector.
That's true. I think government get deeply involved, and also all the major financial institutions get involved. I think a lot of the institution, if they cannot control the risk, or the individual family, they just put too high of the leverage to purchase a house. That will get in the big hard situations right now.
Yeah, that's actually a new phenomenon. Used to be everybody bought their house with cash. Now,
Yeah,
now
but another thing is if you see the real estate ETF in China, they already get that rebounded.
Yeah,
So
true.
this is already get a drop for almost 1 year. That really means the market know the problem. They already price in.
Yeah, just from an investment thesis, if you're looking at this sector, you have to be looking at the largest names. All of those other smaller guys, they're really, really at risk at this point.
That's true.
Yeah. So the second topic today is this looking inside an ETF. It came up in a conversation I was having earlier in the week, and I was looking at VWO, which happens to be the largest emerging markets ETF. And things move quickly, and nobody sends an email. So we need to talk about emerging markets. And I'm not going to throw shade at MSCI or FTSE or any of the other index providers. But we need to call out some obvious problems. The largest EM ETF is VWO, $82 billion, blithely following some cobbled together notion of allocation. So let's look at what's inside. And if I just told you emerging markets, you might think of the old school brick, as people used to call it. Nobody uses that term anymore. But if you look inside these products now, China, which includes Hong Kong, mainland, and then US listed Chinese stocks, China and Taiwan make up more than half of this portfolio. And the next name, India, Brazil, South Africa, and then you're just going to fall off. So a lot of these countries represent a very, very small portion of the allocation, whereas China and Taiwan represent the lion's share of that. And then, what does that mean specifically for stocks? It means a lot of tech and a lot of the US listed China tech. So Tencent, Alibaba, Meituan, these are companies that are listed in the US and that are in this portfolio, have huge weights. Now, another thing, we're going to put up the top 20 holdings or whatever, but another thing I wanted to talk about was how many stocks are in this portfolio. There are 5,000 stocks in this portfolio, and the top, 10 names represent 20% of the portfolio, something like that. So you have 5,000 names in a portfolio. It just seems like a very bad mashup of exposure.
Firstly, while we see the ETF, we see the investable universe. So I think if you combine all the investable universe, it makes sense. China, Taiwan, India, Brazil, South Africa, and Russia, that all looks get included.
But in my estimation, this is silly now. We have to stop calling China an emerging market, seriously, because it's the second largest economy. It's got a huge and deep liquid stock market. It's a massive bond market. It's preposterous for us to say and squeeze this into an EM. The reason I'm so adamant about this is because not only is this fund $80 billion, the next two are like $60 billion each. So there's a massive amount of money following this EM theme, and this EM theme doesn't really hold up. It doesn't make any sense from an investment thesis. There's no reason to group these together. If you were thinking about an asset allocation model, you would think about maybe the large economy. I mean, Japan doesn't come up anywhere here. Well, because we don't think that's an emerging market, and we don't think the US is an emerging market, but somehow China is half of the emerging market. So it just seems like a silly allocation. So people should understand better. And the reason we're bringing this up today is people should understand better what they're investing in. And I can guarantee you, if you asked somebody who owned this fund, said, hey, listen, did you know like 6% of your fund is in 2 US listed Chinese stocks? I don't think many people would believe that.
I agree. Like you said, so I think from an asset allocation perspective, you cannot just throw the money into a big basket. Yeah, it's you have to spend some time and have knowledge, or at least outsource some of the experience and the knowledge from a third party to construct the portfolio. I think it's a good way. It's just to still, it's better to constructed by the country ETF rather than put into the big basket. Otherwise, you
and
just
the other
don't
thing
know
is
what's going to include.
yeah, we spend weeks talking about the divergent performance of just China stocks. So, throwing just all of this China into one basket, again, doesn't really make sense to me because the size of the market is so large now. There's just no way to capture it accurately. If you're an allocator and you say, you know what, I want to have exposure to China, well, that's a decision. And in order to execute that decision, you need to have more thought than to just say, well, I'm covered in my EM fund.
That's exactly right. So if you have the thought, get a China exposure, you definitely you cannot just put it to the EM fund.
Correct. Yeah, and that's where people are abdicating a lot of responsibility. They're saying, well, I have China exposure through my EM fund, and you have some notion of China exposure, but you don't know what you own, you don't know what you're exposed to. I mean, the top 10 holdings of this, there's 8 China and 2 India. I think that's probably something like that, or 7 China, China adjacent, and a couple Indian companies. And that allocation is a massive, considering there's 5,000 stocks in this fund. Anyway, I'm ranting about the design of this ETF, and based on a notion that existed maybe 10 years ago that EM is something to invest in. It should go the way of the brick. Nobody talks about bricks anymore, and I don't think people should be so naive to just say invest in emerging markets, because the definition of that is pretty vague at this point.
Yeah, I think I just checked the entire ETF fund process. Looks like it get rebounded from the April 2020, and then it get up for almost 1 year. And right now it's okay. It's already adjusted for almost 6 or 7 months. The emerging market fund have a worse performance compared to the developer market. But right now is the style get a switch quickly. I don't know at this time.
Yeah, that's why people have to understand better what they're looking at. So with that, we're going to wrap up show R2. Thanks again for tuning in. Appreciate your support. Look forward to seeing you. Hit the subscribe button if you haven't already, and we'll catch you next week.
Thank you.